Good morning, everyone. So first of all, thank you for the introduction, and thank you very much to the organizer for including the paper on the program. It's really an honor for me to present at this conference. So this is joint work with Yashar Baradei and Dmitry Muravyev. I should say that since Yashar is affiliated also as an affiliation with the SEC, that nothing I'm going to say or that's in this presentation or in the paper necessarily reflects the views of the SEC. So this paper is motivated by the strong, very strong stylized facts that in empirical asset pricing that past returns tend to predict future returns in the cross-section. So namely that there is evidence of short-term reversal. For instance, when you look at recent returns, there tends to be cross-sectional reversal. There is momentum, as is the focus of this conference, that when you look at returns over the past 6 to 12 months, there tends to be continuation. That is, past winners tend to keep on doing well, and past losers tend to keep on doing poorly. And there is also evidence of short-term reversal when you look at returns over a longer horizon. So this literature has spawned a lot of research, and so if I look at the seminal momentum paper of Professors Geczy and Titman, there's more than 14,000 citations on Google Scholar, so there's been really a lot of interest, and I think that one of the reasons for that is that the interpretation of the patterns is often challenging, whether these patterns are due to, for instance, compensation for risk, or whether this is something more behavioral explanation due to underreaction or overreaction, for instance. So in this paper, we try to add something to this large literature by examining the role of private and public information for theories of momentum and reversal. So I will not go into the details of different theories, but I just want to mention a couple of possible channels. So for instance, if you think that there are many informed investors in the market, and so they trade on this information, but if investors at the same time fail to learn from prices, then what you will get is that prices will underreact to private information, which is going to generate a drift and which could explain momentum patterns. So you could have a similar story with public information, that is, investors underweight public information signals, and this is public information that generates a drift. Still other stories would be that, for instance, you have one group of informed investors, or their information is correlated, and so if these investors are overconfident in the precision of their own signal, so they will tend to trade more aggressively on these signals, and what you will get is that prices there would overreact to private information, but at the same time there will in general be underreaction to public information. Okay, and so perhaps also there is just no distinction between the different types of information, public and private, and you would just get that there is overreaction to past returns in general without any distinction between whether these past returns are induced by private information or by public information. So if we want to add light to this debate, so the key challenge is that we need to be able to identify price moves that are induced by public news and by private information. And the key challenge is that you need to be able to identify public news, and in particular relevant public news, because there is news that is disclosed all the time in the market, and so as a result it's kind of a lot of these news are not really relevant. So first of all, this is challenging, and I will discuss one paper that attempts to do that, but this is challenging, and this will also typically result in a very limited sample. Okay, the reason for that is that you need to have a data set of news, right? So you won't get access to a very long sample if you want to do this kind of exercise. So in this paper, we are going to take a different approach, and so we are going to use the fact that we think that public news are going to drive overnight returns to a larger extent than intraday returns. Okay, so this is a relative statement. We are not claiming or saying that public news do not matter for intraday returns. We are only saying that they should matter more for overnight returns than for intraday returns. And there are several reasons for that. First of all, there is just, for the majority of our sample, there is either no or very limited trading after hours. Another reason is that even if you think that it could be the case that some information, some private information is incorporated when the US stock market is closed through the trading of stocks that are listed in exchanges in other countries, it does not appear to be a strong factor. So there is this paper by Barclay and co-author who find that, for instance, the trading of stocks listed on the Tokyo Exchange is negligible, of US stocks listed on the Tokyo Exchange is negligible and does not appear to really contribute to price discovery. So their conclusion is that it takes a lot of trading for private information to be incorporated into prices. So there is also this well-known paper by French and Roll, in which they make the point that intraday returns primarily reflect the impact of investors trading, as opposed to the impact of news. And the way they are able to make this claim is that they are going to compare business days, so regular business days on which the exchange is closed, to regular business days on which the exchanges are open. So kind of the flow of public information should be about the same on these two different types of days, but on one day there is trading and they find that there is much more volatility on this type of days than on the other days. And finally, the most kind of precise evidence that we have for our motivation is from this paper by Buduk and co-author, who actually use textual analysis to identify relevant news. And so they found that news account for about 50% of idiosyncratic overnight volatility, but only for about 12% of intraday idiosyncratic volatility, okay, which is consistent with our motivation. Clearly, there is going to be noise in these signals, but as I'll explain in a couple of slides, the big benefit that we get from that is that we are going to be able to leverage almost 1 century of data. Okay, so we are not limited by the availability of a news data set. And so then once we agree on this motivation and we use these past day and night return signals, then the rest of the paper is very straightforward in the sense that you can decompose returns over any period into an intraday component and an overnight component. So for instance, if you look at the monthly return, right, you can decompose it into the product of the overnight return over each day times the product of the intraday return over each day. Okay, and so basically this gives you kind of the overnight component and the intraday component of the monthly return. And so we are going to construct the traditional signals that are used for these standard asset pricing strategies. And so, for instance, the short-term reversal will look at return over the previous week or previous months. The momentum strategies will look at returns over the prior 6 to 12 months, excluding the last months, so as is standard. And so finally, the long-term reversal strategy will look at returns over the prior 3 to 5 years, excluding the last year. And then we are going to look at equal-weighted and value-weighted portfolio returns over the next months with NYSE breakpoints. So those are going to be decile portfolio. So just to be clear, so the returns that we look at from these strategies are going to be standard. So this is 1 month standard return. So we do not examine in these papers when returns are realized, whether the return of the momentum strategy are realized intraday or overnight. So if you're interested in that, so there is other research by Donglu and co-authors. I have also a paper on that as well, which looks at when the return on different types of anomaly strategies are realized. So this is not the focus of this paper. Here, the intraday and overnight return are going to enter only in the strategy signals. Okay, so let me briefly mention the data sources because as I said before, one of the important things for us is the availability of the data. So you can get open prices from CRISP for NYSE listed stocks from 1926 to 1962, and then you can get them for all stocks post 1991. In order to bridge the gap, we are going to use open prices reported by Global Financial Data for 1963 to 1991. And so that's where my co-author, Yashar, has done some work on that. And so we spend a lot of time making sure that this data, cleaning this data and making sure that it is reliable. And so we find that you can match about 88% of all daily CRISP observations and that if you look at this matched sample, it's highly, the characteristics are highly similar to that of the CRISP population. So whenever you want to work with open prices, there are always concerns with kind of the reliability of these prices. So as a robustness check, we are also going to use trade and quotes data that is available basically starting from, that we can use starting from 1985. And here our main kind of robustness data set would use quote midpoints that are taken 15 minutes after the open. Okay, but I should say that since we are going to use these intraday and overnight returns as signals, any noise that's in these opening prices should kind of attenuate our results, going to introduce noise in the signals. So that's the main result of the paper in one figure. So what we do here is we form these standard asset pricing strategies, reversal, momentum, and long-term reversal, and we look at the monthly alpha, the three-factor alpha. This is over 1963 to 2019. And so the gray bars in this figure show you the alpha of the unconditional strategy, just based on the total return over the prior months, prior 6 months, prior 12 months, and so on. Okay, and so there is this well-known evidence of short-term reversal, intermediate horizon momentum, and then some kind of weaker evidence of long-term reversal. So what is new here are the orange and blue bars. Okay, so the orange and blue bars basically show you the monthly alpha of the strategies that are constructed based on past intraday and past overnight returns. So as you can see, the short-term reversal strategy is much stronger if you use the intraday signal than if you use the overnight signals. Okay, so it's much more, it works a lot better. For the momentum, it's the same thing. That is, if you use the past intraday signal, you get a much stronger momentum alpha than if you use the past overnight signal. So unconditionally, just using the past overnight return does not yield any momentum profit. The alpha is basically 0. And finally, if you look at the long-term reversal, what you get is that there is evidence of long-term reversal, but only based on the past overnight return, okay, not based on the past intraday return. So what's important is that it also suggests that the overnight signal is not pure noise, right? There is some information, but it's only predict negatively future long-term returns. So before I discuss the interpretation of the finding, I just first want to make sure that they are robust. So we do several robustness checks. The first one is that we look at stocks in the bottom 20. We exclude microcaps. We exclude days around earnings announcements. It doesn't matter for the results. We also look at value-weighted portfolio. So those are the results for the momentum alpha. And as you can see, they are very similar. So there tends to be a little bit stronger. So there is a little bit stronger evidence of overnight alpha based on the past overnight signal, but it's clearly the intraday strategy that generates a much more sizable alpha. If you look at long-term reversal and we use value-weighted return, there is nothing. Okay, so it's kind of one first piece of evidence that those are two separate effects because it's just much weaker. If we look at short-term reversal, it's also much weaker with value weighting. So here is another robustness check. Here we focus on more recent data for which we have access to this trade and quote data. And so we can basically use as the opening price the mid quote at 945. Okay, and so here we see that the patterns are robust. If you look at short-term reversal based on the prior week or the prior months, it works with intraday return. It doesn't work with overnight return. There is even evidence of continuation for overnight return. If we look at the momentum profits, again, it's much stronger when it's based on past intraday return than when it's based on past overnight return. And over this sample, there is just no evidence of long-term reversal. Here is another robustness check. Here we look at the older open price data that is from 1929 to 1962. And again, the orange bars for the intraday signal, you can see this is very similar to the evidence I showed you before. Okay, so this is in my opinion, remarkably consistent across subsamples. Again, you see short-term reversal is stronger based on past intraday return, but then the momentum, especially, it's also really about the past intraday returns. Here, when you look at past overnight returns, it predicts reversal at all horizons. Here is another way to look at this result. We just look at the prior week return, and then we hold the portfolios over the next year, and you look at the cumulative profit every week. And as you can see, there is initially reversal when you look at the prior week intraday return, but after that, gradually, the strategy is generating positive profits. Okay, so let me now discuss our interpretation of the findings. So going into this project, I didn't have a strong prior about what should be the results for momentum, but in terms of reversal, coming from kind of the liquidity literature, my prior was that there is a lot of evidence that has been shown that reversal can be the outcome of compensating liquidity providers for providing liquidity. That is, investors trade, this moves the price, so if a liquidity provider accommodates the trading demand of investors, this liquidity provider will be compensated by reversal. So my prior was that really intraday, so reversal should be stronger when it is based on past intraday return than when it is based on past overnight return. And so that's exactly what we find, which is, maybe validation is a bit of a strong word, but in my view, it was a nice kind of validation of the methodology. At least it made sense relative to my prior. You also find that if you use value-weighted returns, this is weaker, which is kind of consistent with the idea that this is related to liquidity. Now, if we look at the evidence of momentum, if you think that public news, that the overnight return is strongly affected by public information, by public news, it's a little bit difficult to reconcile the idea that momentum is primarily due to underreaction to public information with the fact that this overnight return does not generate any momentum profit. So another possibility could be that the momentum is driven by investors' continued overreaction to past price movements. Okay, and so investors keep on trading, and as a result of that, this is what generates the momentum, some kind of herding story. But first of all, as I've shown you before, there is, if you look at the intraday momentum strategy, there is just no evidence of long-term reversal, okay, which is kind of at odds with an overreaction story. And then we also have this evidence from prior research that momentum profits are realized overnight. So if this is really due to the trading of investors that follow past price trends, it's not clear why the profits would be realized overnight and not intraday. And finally, one other potential explanation that at least can explain some of these findings is that momentum could be driven by underreaction to information, but information that is conveyed by the trades of other investors. And there, indeed, you would expect that you generate stronger momentum based on the past intraday return. And then, if this is a correction of the mispricing is corrected when public information is revealed, so that would be overnight. Okay, so that can basically explain potentially the evidence that we see here. So another test of the underreaction story that we run in the paper is a volume-based return signal. So you can show in simple models that momentum is going to decrease with volume if either investors learn from prices, so investors learn from prices and realize that there is some information in prices, and so when there is a lot of volume, more information is going to be impounded into prices, and as a result of that, this predicts weaker momentum going forward, less drift. Another possibility is just that public information is released. We know in the data that when there is public news, it generates a lot of trading, and that could also explain lower drift going forward. So what we do is that we are going to split each stock month into below median and above median volume days, and then we are going to compute the past return signals using either days with below median volume or days with above median volume. And so the table here on the left part of the table, this shows you the short-term reversal. That is, you generate, basically it is much stronger when you condition the strategy on high volume days. Okay, which is again consistent with these liquidity theories, that this is really the trading of investor that's pushing the price away from fundamentals, and you get the reversal to compensate liquidity providers. In contrast, for the momentum and further consistent with kind of this underreaction story, so that's the two columns in the middle of the table, there it is the profit is much stronger when you condition on the low volume days. Okay, so it's again seems to be a separate effect. And then for long-term reversal, there is again evidence that it's stronger when you condition on high volume days. If you look at the past intraday return, you get just kind of a similar picture. And if we look at the past overnight returns, we don't see any relation with the volume on the trading days that basically follows the overnight return. So there is no association with that. So there is one thing that we need to be a little bit careful about, is that there are some interactions, there are some complicated interactions between intraday and overnight return. What we do in the paper is that we look at sequential sorts and Pamamac-based regressions. I will just show you the results for sequential sorts. But the issue is that because of this correlation, it's also interesting for us to see what we get when we control when we look at portfolios that are based on past intraday return, controlling for past overnight return. And so this is what's done in this table. This shows you the momentum alpha. When first you sort stocks into quintiles based on the past overnight returns, and then within each quintile, you form the intraday return strategy. You can see that on the right-hand side, basically it works among all quintiles of past overnight return. Okay? Then we do the reverse. So first we control for the past intraday returns, and then we sort based on the past overnight returns. And then here you see on the rightmost column that there is a little bit evidence of momentum based on past overnight return, but you need basically to be able to control for the past intraday returns. Okay, and it's much weaker than what we see when we use the past intraday returns. Okay, so we are not like completely ruling out that underreaction to overnight information can generate some momentum, but this needs to be conditioned on past intraday return because of this interaction. A couple of additional points. It could be that the type of news disclosed overnight differs from the type of news disclosed intraday. We don't find evidence that, based on other papers, that this is the case. We know, for instance, that earnings announcements used to be disclosed mostly intraday early on, but nowadays most earnings announcements are disclosed outside of trading hours. So given that the results are robust across subsamples, it doesn't appear to be a problem. It could also be that market participants react differently to overnight public news than to intraday public news. If you pay less attention to overnight information, then that would go against our finding, predicts more underreaction based on the overnight signal. One possibility, though, is that overnight news appear more salient to investors than intraday news. So what we do is that we look at this concept of information discreteness that's in a paper by Geczy and co-authors, and that it is the idea that you pay less attention to information that arrives continuously in small amounts versus information that arrives infrequently but in large amounts. So for instance, if you have over a 5-day period a return of 0% over the first 4 days and then a return of 5%, you pay more attention to that than if you have a return of 5% or of 1% on every day. And so we show that it does not explain our results. Okay, so we find that you can generate stronger intraday momentum if you condition on more continuous intraday return, but we also still find strong momentum even based on discrete intraday return. And actually for overnight return, it's a little bit puzzling in the sense that there is a little bit of evidence of momentum when you look at discrete in overnight return, which is a little bit at odds with that theory. So there is some evidence of underreaction to news. How does it fit with our work? So there is also a well-known paper by Chan that shows that there is drift after bad news in the previous months. So he looks at a sample of 1980 to 2000. So when we look at past overnight returns over the previous months, actually we find something that's consistent with this paper. That is, if you look at the portfolio with the lowest overnight return over the previous months, we find that there is drift in this portfolio. So this portfolio of stocks did poorly overnight in the previous months. It tends to keep doing poorly in the next months, okay, which is kind of consistent with this finding and with the idea that we use overnight return as a proxy for news. So my discussant, Sophia, has a really interesting paper on underreaction to news over the next few days. So in this paper, we are mostly focused, so we are not, for the momentum results, we basically exclude returns from the previous month, so I think that's a different effect. To summarize, our results do not go against underreaction or overreaction to news in general, but they suggest another important channel for momentum profit. That is that there could be some underreaction to the information that's conveyed through the trading of other investors. That's revealed through the price. And so in the last part of the paper, we try to add a little bit more evidence by looking at analyst target prices. And the idea is that investors' belief should respond differently to the information proxied by past day and night return, basically to kind of trading information and non-trading information. So the question that we ask is, how do analyst target prices incorporate information in past day and night return? And so there is a large literature in finance that examines analysts and their forecast. So we compute the consensus analyst predicted 12-month return. So that's something you can compute from IBES data, and that's called Pirate. And then we are going to look at how it's related to past overnight and intraday return. So in this table, the first column shows you the relation between returns over the next 12 months and past overnight return and past intraday return. So this sample is restricted to 1999 to 2015 because of the availability of analyst target prices. There is always, those are panel regression with date fixed effects. The first column just shows you kind of the result I showed you before, that it tends to be intraday return that predict future returns and not the past overnight return. The second column shows you that there is a negative coefficient for both past intraday return and past overnight returns when you regress the analyst forecast of the next 12 months return on them. And so it suggests some kind of underreaction to this past information, but it is stronger for the past intraday return than for the past overnight return. And when we combine these two columns, you get the last column that looks at the relation between the analyst forecast error and past overnight return and past intraday return. And there is no relation between past overnight return and forecast error, but you can see that there is a strong positive relation between past intraday return and the analyst forecast error, which again suggests underreaction to this information. Right, so I'm out of time. So just to conclude, in this paper, we examined the role of trading and non-trading information for reversal of momentum and momentum. Our results support underreaction theories of momentum, and in particular, they suggest underreaction to information conveyed through trading. So an important takeaway is that the response to public news seems to differ than that to private information. And so more broadly, this paper is in line with evidence that traders neglect some of the informational content of prices. All right, thank you.
Thank you so much for the introduction. Can you hear me? Great. It's such a great pleasure to be invited to discuss this fascinating paper by Vincent and his co-authors that used day and night signals to understand momentum and reversal. So I'm Sophia Lee from Rutgers University, not far away from here. The little bit background about me. So I have been using intraday high-frequency data in my research for more than a decade. I still remember that back in 2010, when I was a graduate student at Duke, I started to process the massive amount of intraday high-frequency data from tech, and it took me so much time. But the good news is that after a couple of years, Wharton has made a cloud platform available for all subscribers and made my life so much easier. So I owe a big thank you to Wharton. Thank you so much for making intraday high-frequency research more doable for most of the researchers. So I'd like to advocate about intraday research a little bit. So with the higher quality of intraday data, we're able to better measure a lot of risks. We can do a lot of forecasting at like daily or even intraday frequencies better for practitioners. Another thing about using intraday data is that we could better understand so many anomalies, right? Just like Vincent's research he presented today. So I hope that there will be more space in the academia for us to do more research using intraday high-frequency data. So Vincent has done a lot of great job, has contributed a lot to the intraday literature. I learned so much from his work, and this one is not an exception. So he did a great job summarizing the main findings of the paper. Let me just give you a quick recap. So we know the momentum effect discovered in Zhengzi and Peterman back in 1993 is one of the most important anomalies in pricing. The Google Scholar citation have to keep updating the number when I prepare for slides because it's going up every day. So it's more than 14,000, okay? And it's highly profitable compared with many other anomalies that have been experienced over time. And it's long-lasting, and it's everywhere. You can see it in different asset classes and in different countries. And in the past 3 decades, numerous theories and empirical analyses have been proposed to explain momentum because it's so important. This paper offers a fresh explanation of momentum. So this paper is based on this fact that news mostly drive overnight new returns, whereas investors trading mostly drive intraday returns. And the authors use this fact to test a series of momentum and reversal with the extended sample over almost a century. And the key finding is that portfolios formed on past intraday returns display momentum without long-term reversal, and portfolios formed on past overnight returns only display long-term reversal. So combining the fact and the finding, the conclusion is that momentum is mainly driven by investors and the reaction to private information conveyed by other streets, not by underreaction to public news. Okay. So they also propose a lot of additional evidence supporting the investors and the reaction to private information channel. Okay. For instance, they show there is stronger momentum sorted by past intraday returns on low volume days because private information is incorporated into prices more slowly when volume is low. Okay? And there is a strong positive association between past intraday return and analyst forecasting error, but you don't see a positive association between forecasting error and the past overnight returns. Okay? Have done a lot of robust checks. Great job. Okay? And the empirical analysis are very thorough and thoughtful. Discussions on alternative channels are also very careful. So overall, it's truly a great paper. Very fun to read and I learned a lot. I recommend everybody in the room to read it. So my job here is to offer some additional suggestions. So I think it's already a strong paper. What I'm going to do is just to propose additional tests that could sharpen the results in the paper. Okay. Let's go back to the fact. News mostly drive overnight returns, whereas investors trading mostly drive intraday return. I wonder if you could perform some direct tests. For instance, you could combine the post-2000 high-frequency news and market data. So after 2000, we have the random pack news data that is available at intraday frequency. Okay. Then you could group overnight news into news-driven and non-news-driven category. So overnight news return would be those accompanied by overnight news. Okay. Then similarly, you could extract news-driven and non-news-driven components from intraday returns. So this is going to take a little bit more time. For instance, for the 9:30 to 4 p.m. interval, you divide them into 15-minute, like intraday intervals. And then you identify those intervals with news. Then you sum up those 15-minute returns with news. So that is the news-driven intraday component. The remaining would be the non-news-driven component. Okay? So if the current hypothesis is correct, then we would expect non-news-driven intraday return to generate momentum, whereas the news-driven overnight return to generate long-term reversal. Okay? And another test, so what if you do not have the high frequency data on news? Then you could perform jump tests on and overnight returns between year 1926 to 2000. So this gives on the insight that we can use jumps as proxy for large information shocks. The overnight return can be classified into jump and non-jump, and similarly, intraday we have jump return, non-jump return. Again, if your hypothesis is correct, we would say the intraday non-jump return to generate long-term momentum, and the overnight jump return to generate long-term reversal. Okay. And my second comment is on whether intraday return could still capture overnight news. So let's look at some of the results in the paper. So if we use the year 1966 to 2019 sample, and we use the 9:30 a.m. trade price to calculate the intraday return, then you see the table is a little bit small, and the cumulative intraday component over the past 2 to 12 months generates momentum with spread of 1.17% per month with a T-stat above 6. And alternatively, if you use the 1989 to 2015 sample and the 9:45 a.m. mid-code to compute the intraday return, then the momentum generated from the past intraday return component is much lower, it's 0.77% per month, and with T-stat about 3. Okay, we know that when we switch from trade to quote price, the momentum should become stronger, right? So if the sample difference does not contribute to the return reduction, it must come from the choice of open price, okay? Because it takes time for the market to process overnight news. Then, using 9:30 a.m. as a market open, like to compute intraday return, could capture market reaction to overnight news. Okay. Another possibility is that investors trade on overnight news not only right after market open, but also right before market close for liquidity reasons. So here I borrowed 2 pictures from Jiang and Yao, 2021. So those pictures present the average intraday volume, okay, across different stocks. So back in 1993, the first image, you see that we still have like a U-shaped pattern, but most of the trading occurs right after market open. But in 2017, you see that huge amount of volume happened near market close. So that said, investors would likely to trade overnight news, at the market open or near the market close. It is also possible that the clientele effect would play a role here, because we know the institutions prefer to trade at the close, whereas retail investors prefer to trade at the open. Okay, so what kind of test you can perform? For the post-1919 sample where we have the intraday TAC data, we could divide the intraday returns into 3 components. So we have the 9:30 a.m. to 10 a.m., the first half hour, the middle section between 10 and 3:30, and the last half hour between 3:30 and 4. Then we try to understand the source of the momentum. Okay? So suppose the momentum is mainly generated by the first half hour return, then it could be underreaction to overnight news. And if momentum is mainly generated by the middle section from 10 to 3:30, then it's more consistent with a slowly diffusion of private information channel. And the momentum, if it is mainly generated by the last half hour return, then it could come from institutions' periodical rebalancing. Okay? So another task you can do is to separate intraday returns into those preceded by overnight news and those without. So for the post-2000 sample, overnight news are directly available from Raman Pack, and for the entire sample, you could use overnight return jump to proxy overnight news. Okay. So if past intraday returns not preceded by overnight news generate equally strong or even stronger momentum, then results would be more consistent with private information diffusion. And if past intraday returns preceded by overnight news generate even stronger momentum, then momentum based on intraday return could still capture overnight news effect. Okay. You can also explore the volume effect here, because volume not only affects the speed of information diffusion for private information, but also for overnight public information. In addition, you could explore the change of pre-market trading hours. For instance, do you see any variation in the momentum reversal generated by intraday or overnight returns around the launch of pre-market trading? Okay. The pre-market trading would allow investors to better process overnight news before 9:30 a.m. If momentum generated by intraday return becomes weaker after the launch of pre-market trading, then the intraday return between 9:30 a.m. and 4 p.m. measured before the launch would likely capture overnight news. Okay. So my third comment is on market news versus private information. So far, the focus has been on firm-level public news and private information. Okay. So could intraday return movement capture delayed reaction to market advice information instead of private information? Okay. In the early sample, only regular hour trading is allowed. Investors cannot trade market news overnight. And in the recent sample, investors still prefer, to trade. They could have more incentive to trade market news intraday due to liquidity reasons. Okay. So how to test on the effect of market news? You could use the price delay measure from Ho and Marquis. I see Tobias is here. This measure captures whether a stock processes market information with a delay. Okay. So my next comment is on why private information generates long-lasting momentum. Why last so long? Okay. So in your paper, you have a model that try to explain the day and night effect. But there is another paper, recent paper by Mongia, Vives, and Young that could shed some light on the long-lasting effect of private information. Okay. So in the model, they propose, in the proposed model in which investors cannot costlessly process information from asset prices. At the trading stage, investors are boundedly rational, and their interpretation of prices injects noise into the price, generating a source of endogenous noise trading. And their setup predicts price momentum. Okay. So one task you can do is to directly explore the rationality or sophistication of the shareholder base. Okay. For instance, you can use the institutional holding or the retail trading activity. The algorithm is proposed in Bowman et al. Okay. So to conclude, this is truly a fascinating paper that offers a fresh look at momentum. It is very well written and very enjoyable to read. Though, in my opinion, it might need more tests to sharpen the combinatorial results. I'll be happy to talk with Vincent and maybe your co-authors as well. And very much looking forward to future versions. Thank you so much for your attention.
The volatility of the overnight returns is much smaller, right, than the intraday returns. And so the spread in the signal is going to be much more muted for the overnight returns. If you compare similar spreads, right, in terms of the signal, do you get the same effect? So what I'm worried about is that you're going to get a much more muted momentum effect just because there's maybe not a huge difference in the winners and losers from the overnight returns because of the suppressed volatility. Have you tried that?
Yes, so that was also exactly a concern because there is this well-known evidence that overnight returns are less volatile. But what's interesting is that actually when you compound the intraday and the overnight return over these longer horizons, kind of the difference in volatility is not that large. There is one still, but it's kind of smaller. And so we tried adjusting for that. And it doesn't appear so there is still a difference, but it doesn't appear to drive the. So I was also exactly worried about this issue.
So you're saying you get the same spread in the deciles when you sort on overnight returns versus intraday returns? So for instance, you could just fix the spread between deciles 10 and 1 in terms of the cutoffs, right?
Okay.
Rather than make it equal, 10%.
So, okay, so we could do that. We haven't done exactly what you propose. So what you propose is that we fix the spread in the past return, and then, okay, yeah, that's a good idea. We could do that, but I was definitely concerned about the difference in volatility. We looked at it. It doesn't appear, but it's a great suggestion. Thank you.
First, thank you, Vincent. The result of splitting momentum into the overnight and intraday components looks very interesting. I'm wondering, when you look at the two formed portfolios as time series, And as they move through different times during like different market conditions, do you observe other different behaviors or characteristics besides like the difference in the expectation or mean? For example, in particular, we know that momentum tend to have larger crashes or spikes when like market is like super volatile. Do you observe differences in the intraday piece versus the overnight piece during those times?
Yeah, so the overnight piece is, I think, mostly not profitable, but the intraday piece, I think, is quite similar to the regular momentum strategy. Yeah.
You show, sort of total return, sort of the intraday overnight, but you actually, what you don't show is, can you reject the now that your intraday mom is different than just the one based on the total return? Similar comment, like since you have a higher volume on intraday return, sorting on those might be just the same as sorting on total return. I was eyeballing your table, but the difference between the spreads, between the long-short strategy, sorting on the total versus the intraday, it's basis point, so I doubt you can tell them apart. My other comment is, you guys cite the Liu and Polk in others paper. There is a, it's true that overnight returns don't really predict total returns, but there is a massive overnight, intraday, and total on MOL. So meaning that past total return predicts future total returns, past overnight return massively predict future overnight returns, and past intraday return massively predict future intraday returns. So that's, that's not exactly consistent with your hypothesis. There is no underreaction of MOL in the intraday. There is. It's very big and just not a difference you are observing. So just thinking, how do you guys reconcile that evidence?
Yeah, so that's great question. So yeah, I've thought a lot about this. So I think relative to their paper, where one of the pieces of evidence is that they find that momentum returns are realized overnight. So I mean, they don't have the 1962 to 1991 data, but when they look at the pre-1963 data, what they find is that their results switch, actually. They find that momentum returns are realized intraday. That's one difference relative to what we have. And indeed, there is something that's inconsistent because they find that past intraday returns tend to predict future intraday returns. So there is continuation in intraday returns, and past overnight returns tend to predict future overnight returns. So here, with the momentum, we find that it's the intraday signals, but like in the recent sample, it's the returns are mostly realized overnight and not intraday. So not kind of exactly consistent with what they have. So I think it's probably due to a difference in the horizon at which they look at the returns. I think they look at the past months and then look at over the following months at what's going on. But yeah, it's definitely interesting to think about how our results relate to their results. Yeah, so that's my take on that.
Two questions I have is, one, when you're looking at the momentum, are you looking at it in isolation or other factors such as what macroeconomic regime we are in, and is liquidity taken into consideration if real money needs to be put to work for this kind of a strategy? Have you done some kind of analysis on that? And second is, have you tried to look at momentum in an absolute return terms, like canceling the momentum and reducing the beta of a portfolio to see if can you generate some kind of an absolute return through the momentum strategy?
So no, we didn't. So we didn't look too much at kind of the time series of profits and how they relate to market condition. I think that's definitely something we could do in the next iteration of the paper. So I think that's a good idea. And then we just stick to very kind of the basic strategy. We didn't try to kind of fine tune the strategy to increase profits. So that would be, I guess, maybe for another paper.
You mentioned some robustness checks about dropping microcaps as well as trading days around earnings. Did you try a robustness check about changing your sample size? I think you mentioned that you started back in like 1926. So did you try different kind of year windows or decade windows and find that there was any non-stationarity in the parameters or signal strength you were calculating?
I mean, so the only thing we did relative to that is what I showed, is that we looked at different subsamples. So we looked at 1963 to 2019, we looked at 1926 to 1962, and then we looked at 1985 to 2015. And So that's kind of the only thing we did, and we found that kind of the results, at least for the intraday strategy, they are consistent across these 3 different subsamples, which I think was reassuring to me because, as I said before, some of these results in other research on when intraday and overnight returns are realized doesn't necessarily appear to be consistent between like in the old CRISP data relative to the more recent data. So, but yeah, we didn't do more than that. We just looked at these 3 subsamples. Yeah.